opening remarks before I bring in our guest to join this conversation. On the subject of short selling, Warren Buffett once remarked, and I quote, "It's common for promoters to cause a stock to become valued at 5 to 10 times its true worth, but rare to find a stock trading at 10 to 20% of its true value." So you might think that short selling is easy, but it's not. I think what he was basically trying to say is that it's common to see significantly overvalued stocks for extended periods, and extremely rare to find significantly undervalued stocks. Yet the practice of short selling those overvalued stocks is not easy. Short selling is really a practice of selling a stock that you don't own in the anticipation that you can buy it later at a lower price. Did you know that Warren Buffett, whom we follow so closely in India, used to short stocks in his partnership years of the 50s and the 60s? In fact, as recently as 1995, he was short the US dollar of a nominal value of, I think, around $20 billion or so. Let me assure you that short selling is a rare skill. In fact, it's an art. Therefore, nothing gives me more pleasure than to introduce today someone who is among the best, if not the best, at this art of short selling, Carson Block. Carson is the founder and CIO of Muddy Waters, an activist money management firm. Moneyweek calls him the world's most feared short seller. Carson's specialty is to focus on shorting companies with fraudulent or questionable business or accounting practices. He identifies these opportunities by extensive research and due diligence on companies around the world. The mere mention of his interest in shorting a stock leads to a decline of 20 to 30% in its price in a day. Such is his reputation. He is known to have wiped out $3 billion in market value of Sino Forest, then Canada's largest forestry company, after exposing the company as a massive fraud. Carson is also known for his activist campaigns on Chinese companies listed in the US, which led to numerous financial restatements and several delistings of such companies. Bloomberg Markets magazine named him as one of the 50 most influential in global finance in 2011. The following year, he received the prestigious Boldness and Business Award from the Financial Times. Carson is featured in the book, The Most Dangerous Trade, by former Bloomberg writer Richard Tultebaum. He is also featured in the 2018 documentary, The China Hustle. Carson, it's an extreme pleasure to welcome you today and a pleasure to have you with us.
Well, thank you. And thank you for spending late Friday night, here with me. So hopefully you'll find that it was a good trade-off.
I'm sure. Carson, why don't we begin with getting into a bit of your background and how you got into the trade and what excites you about this practice of short selling, and we can take it from there.
Yeah, so I'll nutshell it, but there's a lot of psychological issues that go into it also. And Institutional Investor just did a profile on me on Monday that's by far the best that's ever been done, and really goes deep into why. But the short of it is, I grew up in the market. My father was a sell-side analyst and institutional salesperson. And when I graduated university in '98, I first went to China to try to open up an A-share research firm. But after about 6 months, I figured that I was probably 10 years too early at a minimum, at least if I wanted to find anything investable. So I came back to the States, did iBanking for a little bit, hated it. And then I worked with my father for a few years in microcap equity research. So that was late 99 through 02. And we just got lied to constantly, it turns out. I mean, we didn't know it at the time, but some of the things that we had looked management, CEO in the eyes or CFO in the eyes and heard them talk, just turned out to be frauds. I mean, one of them was actually adjudicated to be a fraud. And my father had been pretty close with the CFO there. It was a company called Rentway. He'd been close with them for over 4 years. So at the same time that this was happening, the largest companies in the world were blowing up in scandals as well. That's Enron, WorldCom, HealthSouth, Tyco. So I just felt that as much as I wanted to be an investor, the market, at least being in equities, I mean, from top to the bottom, the market was just filled with charlatans and liars. So I didn't really know exactly how this was going to help, but I decided to go to law school because I thought that having a legal background would help me to better protect myself as an investor. And yeah, the long of it is I really enjoyed law school more than I thought I would. Went to work as a lawyer in Shanghai for Jones Day, left after close to a year and a half. I set up the first self-storage business in mainland China. Got beaten up doing that, but I learned to see the matrix. And when it was my time in China that doing the real world business, that I saw just how easily illusions were created and perceptions were manipulated. So in late 2009, my father got very interested in some of these Chinese companies that had listed in the US. He asked me to diligence one of them for him. And to my shock, I mean, these companies were audited. The last domino to fall for me was that of the auditors. Up until that point, I had assumed, like I think 99% of investors do, that auditors are actually there performing some sort of anti-fraud function. But I mean, I don't joke, literally they are not. So, this company turned out to be a total fraud. It had just reported 103 million in rev. The real rev was probably 2.5 to 3 million. And I don't know. I mean, I didn't really have a business plan in mind. My father wanted nothing to do with the stock on the long side or the short side. And I was basically up to my eyeballs in debt at that point with, the miracle of self-storage having incinerated my savings. So just really no good reason, just put together this report over a few months as a side project, exposing Orient Paper as a total fraud. And June 2010, I was a guy who owned a single warehouse self-storage company. I sent it out to the ether to like 50 people in the market I'd last talked to 9 or 10 years earlier. The report went viral, and 1 year later, Bloomberg named me one of the 50 most influential in global finance with, Ben Bernanke and Christine Lagarde and Warren Buffett. So it was like winning the lottery. And, I guess the final thing I'll say by way of background is the next roughly 18 months were sprint. Almost all of these Chinese companies were substantially fraudulent, and it was this weird game that we were playing. And I was now at that point racing some other activist short sellers to be the first to expose them. We knew there were frauds. We just had to go and assemble the proof, package it, and put it out and say, oh, it's a fraud. And then it would boom, implode. And but after sprinting for about 18 months, came up for air, and I thought about this, and I realized that the conflicts of interest and the dysfunction that enabled these empty boxes to list in the U.S. and trade for real market cap, often north of $1 billion. It's just the same conflicts of interest and dysfunction that I ran into earlier in my career and really had driven me out of the investment business. So with a bunch of anger that I carry with me, from childhood and from my early career, and, in my time in China, also watching, that guy get away with it constantly. I just took my poison pen and started researching other companies and globally, and I'd say most of what we do, it's not actually the from a legal perspective, it's not the frauds. Because it's, in a way, it's kind of like fraud is for idiots, right? If you cannot figure out how to manipulate your financial statements significantly without crossing the line legally, you're not exactly that bright. So what I'm saying is that in many industries, accounting standards give so much latitude for companies to manipulate their financials. So a lot of what we do is just demanipulate the financials. Basically, we explain what's really going on, and and we short the stocks ahead of publication, ahead of launching a campaign, and yeah, put the information out in the market. And if the market likes the information, thinks it's good, we make money. If the market doesn't, we don't make money. And that's really what our business as activist short sellers is.
Right. That's very interesting. You made a comment that, in India also, we assume that if it's a big four is auditing a certain company, then the accounts must be clean. Nothing is further away from the truth. And in fact, the one very prominent fraud that we had in India, which is Satyam Computers, had one of the big fours, as the accountants as well. But, when I kind of read your story, Carson, it seems as if you accidentally got into this trade and you found yourself, right? Yeah. So is there a personality type to a short seller? Are you a punisher? You like to punish the bad guys? Is it, that you're naturally aggressive? Are you anti-authority? Do these characteristics, form a part of you because of which it also attracts you to short selling?
Yeah, so I'll speak generally and then specifically. One thing that I've noted about most short sellers is that most of us are socially awkward in some way. And what I think that does, like the vast majority of short sellers were not captains of the football team and did not date the cheerleaders in high school. So they were basically marginalized. I think a lot of us were socially marginalized. And so we're forced to kind of look at the pretty people, in the mainstream and look at it with look at them with a very critical eye. And so I think, it's somewhat similar, I think, to that point that Michael Lewis made in his book about the financial crisis when he wrote about Michael Burry. Right. He was somebody with Asperger's and a glass eye. And, it's when you're not part of the mainstream, but you're reasonably bright, it really forces you, I think you end up thinking in alternative ways. So I think most of us come from that, from some background analogous to that. Now, if you look at Jim Chanos, who's really the dean of short sellers, and just an incredible intellect. Jim went to Yale and I think he was a good athlete. So for Jim, I don't know how he, why he got so, focused on this, but the activist side of short selling, going out and trying to expose people who are taking advantage of others, and really, in my view, violating tenets of business and markets. Right. Look, as the II article discusses, I had a pretty rough early childhood, and that imbued me with a lot of rage, and it was hard for me early in life dealing with that because I couldn't control it, and so I was very self-destructive. I was constantly getting in trouble, and I'd always fight authority, and authority would almost always win. So the adjustments I made in life, especially when things got better for me, were to learn to control that rage. And so when I began, when I did stumble into this, there was activist short selling before I wrote my first report. I didn't know about it, and it was very niche. And so I think that, my firm and I have played a real role in making it much more mainstream than it was. But almost immediately after I wrote that piece, and I had some of the biggest hedge funds in the world, names I knew, even though I hadn't been around the investment industry for a decade, reaching out and wanting to talk, it was very gratifying because the rest of my life, or my life up till that point, I felt like I was always espousing contrarian viewpoints that often turned out to be correct. At least in my mind, I'm biased, but nobody gave a shit, right? It's just like, shut up, man. But people suddenly cared because they're more pragmatic about their money, which they're not necessarily that pragmatic, but I think people are much more pragmatic about their money than they are about so many other aspects of their lives. So, I mean, I grew up basically an atheist, or I was baptized, but I turned into an apostate. And I used to debate people on the existence of God. Like, you can't win that, right? But like, people don't want to change their beliefs. But when it comes to their money, people are a lot more willing to change their beliefs. And I mean, we do run into intellectual and personality barriers, I'm sure, when we're trying to make our arguments. I think a lot of people, if they're long a stock that we're short and we're saying, hey, these guys are, completely fooling you, it's hard. It's hard for some people to not take that personally and make it seem like it's an affront or an accusation that they are gullible and naive. But the reality is, we've all gotten scammed. I've gotten scammed hard, even after starting this business. So it's not about intelligence. It's just, I find, and I'll pause in a second for your next question, but one of the things that I think is really important to understanding why we can do what we do, and I wouldn't expect long-oriented investors to be able to do this, is you just have to have a different mentality when you're looking to be a long buyer, whether it's of a stock or of potential hire, talent. So when I'm hiring, it's a good example. It's diametrically opposed process from when we're looking at a public company that might be problematic. When we look at a public company that might be problematic, we're looking for any tell that there's something off and what it might be. But when I'm looking to hire somebody, I can't think like that. I have to think about, the good side. Like, is this a person who would plug in well? Are there synergies there? Do we get along well? And I just cannot switch hats and suddenly think, now, is this person telling me everything there is in his or her background that's relevant? I bring in other people to do that work. So that's one reason why I think de facto, when you have managements that are lying or being highly deceptive, I think that's why long side investors, just fall for it. Is you just, you need a different mentality when you approach those companies.
Yeah, I mean, I think what strikes me is that you need to keep a balance, that you can't be overly pessimistic as a person, but healthy cynicism is always good. I mean, that's really what strikes me. Carson, let me just step back for the benefit, of our audience. They're not necessarily familiar with a short-only fund. In fact, even the hedge fund world in India is still evolving. There are just a few hedge funds in India. There may be 8,000 in the US. So India is still an evolving space there. Why? So just to understand, what should one expect from a short-only fund? Which is, am I investing in this as an insurance to my long portfolio, or am I expecting a return? And there are other ways to look at it. What is your batting average? What are your hits and misses? How many down years to up years? If you could talk a little bit about that.
Okay, well, those are very good questions. And so let me first, though, also just kind of clarify. So short selling is a niche. And so maybe the universe of good shorts is this big. Activist short selling, which is what we do, is a niche of a niche. Yeah. And so that might be the universe of good activist shorts. But yeah, I mean, short, I think the proper way to look at short exposure in general, and we actually run more market neutral these days, where we're hedging out our shorts by going long side. We're going long factor baskets on the long side. But because with all the stimulus out there, I mean, the markets do go up. A lot of the things that we short do go down in absolute terms over the long term, but there's more alpha than there is actual depreciation, just because how markets really are manipulated effectively by central banks these days. So I think the proper way to consider, or to really think about a traditional short only product, is that it's, you're long the world basically, or you're long India, but there will be rainy days. And so the idea being that over the long term, by being short, if you have a manager that's creating alpha, but probably losing money is the reality in that space, when you're going to have less volatility, but the give or take the same expected returns over the long term. Now, That's the traditional view, right? But I cannot tell you how many conversations I've had with allocators since we launched in late 2015 that where they start out by saying, so, we're long everything, and we're worried about the markets, and we're looking for short exposure, but we're tired of losing money. So, well, I don't know, man. You got to pick your poison. And so, what we do as activist short sellers has always been slightly inversely correlated, is the way that I would look at it. So we're almost non-correlated, because the big problem that is, post financial crisis, the big problem that short sellers have had is that they're right on their theses often, but they just get the timing so wrong, because with debt being as cheap as it is, these companies are just able to really postpone their days of reckoning for a long time. Just borrow cheaply, go on acquisition binges, just papering over the problems. So that's the thing that is really frustrating for those guys, the short sellers is, they are right, but if you look at some of these things like Mallinckrodt, which was formerly Questcor. So I know people who were shorting Questcor when it was a single drug company. So this Actar gel, which has been around for over 40 years in the US. It was used for the treatment of infantile spasms, which is a very rare condition. It's a horrible condition, if you have a baby who has these kind of spasms and night terrors. Always very questionable efficacy. But the problem is, when it's people's kids, they don't care. They'll try anything, right? As long as it's not potentially harmful. And so Questcor had acquired the rights to this and just started jacking the prices up. Welcome to the whole, United States pharmaceutical market, but just massively, exponentially increasing the prices. And again, it was questionably efficacious, but the guys who were short this expected the insurance companies, actually, I shouldn't even say questionably efficacious. It was clear that it was not efficacious, but everybody expected the insurers to stop reimbursing for it. Well, guess what? The insurers said, you know what? It's such a small number of scripts that we have to pay for. The headline risk to us, stopping reimbursement for something that afflicts, babies, we don't want to deal with the headline risk. So it kept going. And then Mallinckrodt came along, and it was an Irish pharmaceutical company that was basically trying to addict as many Americans to opioids as possible at the time. And so they came along and acquired Questcor. And, then there was this, even better short thesis, because it's Actar gel and the opioids. Right. And man, it didn't blow up till, I don't think it blew up till 2020 or late last year or early this year is finally when Mallinckrodt went BK after the opioid settlements. And again, there were guys I know who were short that, I think, 9 years. Wirecard's another great example. Yeah. Some people started shorting that around 2008, 2009. And the thing just went, ballistic until it collapsed. So, and
it was a $20 billion market cap company, right?
33 billion euro, actually, I think,
wow.
At peak. Yeah. Wow. Now, that had a lot of help from the German state, but in terms of protecting the fraud, but yeah, so traditional short selling, where you're not putting this information out into the marketplace, it can be very difficult. Now, to be fair, both of those companies I named, Questcor and Wirecard, were actually subjects of activist short sellers who did put the information out in the marketplace, and even then, it was still really hard. Right. So, it's it's very difficult post GFC. If you're not an activist short seller. And the other dynamic there that exists in the US, and I'm not sure to what extent it does in India, but we used to have media that had a robust investigative journalism component to it. And long form journalism, investigative journalism is basically a money loser now for media organizations. And that's certainly true in financial investigative journalism. So there's hardly any financial investigative journalism left. In the old days, guys who ran short only funds, if it were, you can kind of break your shorts down into two categories basically. And the vast majority are the fundamental shorts, the melting ice cube shorts. There's nothing to do there in terms of disseminating a story because it's very forward looking. And that one is also like arguing about the existence of God. Like I think their product launch is going to flop. And, the other side is like, no, we're confident. You can't prove it till you get there. But then you have this much smaller, more niche category of companies that are deceptive or lying, basically. And that's a great short if people realize that they're deceiving or lying. But again, you used to be able to rely on a financial media to get these stories out. You can't anymore. I mean, there's just very little of that. So we, as activist short sellers, we kind of we fill that vacuum to some extent.
Right. I think institutional investor did quote your returns, 19% CAGR for the last 5 years. And I think those are fantastic returns, something that long only funds would, kill for. You talked about towards the end, the role of a short seller. How many frauds until revealed by the promoters themselves or the sponsors or the management themselves have been unveiled by auditors, investment bankers, regulators? Can you think of any?
So
you require really a short seller who's incentivized to find these frauds, right?
Yeah, I mean, and short sellers or journalists. So there was a study that was done a few years ago that I'm fond of quoting, and it looked at fraud discoveries in Western companies, and they were not necessarily all publicly traded companies, but I think it's found that auditors were responsible for only 4% of fraud discoveries. I think the single largest attribution of fraud discovery was accidental. Now one of the things though that you also have to keep in mind when thinking about that is a lot of that fraud was fraud committed by lower level employees or fraud in various divisions. When we deal with fraud, we're dealing with fraud that's committed by senior management. And that's one of the problems with audits is that the professional standards of audit. So in the US, to be liable for professional negligence, you need to violate the professional standards. Your conduct needs to fall below those standards. And the professional standards of auditing presume that the documents and information that you as the auditor are given are true and correct, and that management is telling you the truth. So if the documents and information is false and or management is lying, you generally have a way to escape liability. And that's just saying, well, they lied to me. Because when you think about it, I mean, the people on an audit engagement team who handle the documents are the people who are just like fresh out of school, 23, 25 years old. What do they know about spotting forged documents? Unless somebody dates something like February 30th, it's probably pretty hard for them to catch, a fraudulent or forged document. So that's one of the reasons why auditors it's not what they do. Really, the only anti-fraud process that's in most audits is cash confirmation. But here's one of the dirty secrets of audits that really bothers me. And there's so much opacity around audits. So when auditors in China, after we and others started exposing all these frauds and they went down and before auditors there decided that strategically they needed to stop confirming fraud, and that's a really big, interesting political, dynamic. But what they started doing was they would go to the bank, because the banks, people at the bank were often in on it. It doesn't really take a lot of money to bribe, your branch level employees and managers. So the auditors would go into the bank in some cases, and they would deposit a nominal amount of money into the account. And they would say, okay, now print out the statements right away. And they want to see if, that transaction was there. And then they would know it was a genuine statement. Now that's reasonably thorough. And they would do that not just at the, on the ending, period end dates, and not just on December 31st. They would do it intra-quarter if they were really being serious about it. But you can do cash balance confirmation in a completely opposite way. You just send a letter to the bank saying, hey, we want to confirm that the cash balance in this account as of December 31st was blank. And, the bank will send it back. But again, those people can easily be bribed. So there's so much distance in between those two. And when you read the audit opinion, an unqualified audit opinion, you as an investor, you have no idea the level of diligence that went into it. And another thing that I learned when I interviewed somebody as a potential hire some years ago, he'd been a junior accountant at a Big Four firm in the UK. And so one point in his career, he was in London. The other point, he was in, maybe Manchester or another city, same firm. So one of the offices, the culture between those two offices with respect to audits was radically different. So one of them, they said, hey, if you as a junior auditor, if you find an issue, we'll give you, £1,000 bonus or something like that. So they were incentivized to look hard. But the other office was completely different. They said, listen, don't do anything to slow down the audits. If you do, that's going to be reflected in your annual review. So, okay. And so again, you don't know what audit was done when you're reading these audit reports from the outside, and the audit industry loves it that way. They spend a lot of money lobbying in the United States to protect themselves from transparency. So there you go.
But have you found regulators to be more supportive to detect frauds? I don't think you can expect investment bankers to be helpful.
So I think a lot of people misunderstand the role of regulators with these things. When something blows up, you always hear people say like, oh, where were the regulators? The theory behind regulation, regulators are not the frontline defense. And especially in the US, I can't speak to India, but the US, our philosophy in general, economically is, the idea is that the US is a bad place to be stupid. So companies it's a disclosure-based regime. So companies are forced to make these disclosures, but the regulators aren't generally there reviewing them to look for crimes. And the theory behind enforcement in most jurisdictions is that when something does blow up and the regulators react, by investigating and then prosecuting the perpetrators of it, that has an effect of, the Chinese have an old saying, kill the chicken to scare the monkey. So if you prosecute Ken Lay and Jeff Skilling, then you're hoping that the next Ken Lays and Jeff Skillings will say, you know what? I don't want to do this. But I feel globally, and there could very well be markets in which there are exceptions, but I feel globally that since the financial crisis, there's just been a tremendous corrosion of the rule of law in many markets and jurisdictions, and especially the United States. And so it has the opposite effect. Like everybody's doing it. Not everybody's committing fraud, but this aggression with accounting and financial engineering, everybody's doing that. It's kind of like, if you're not doing that, you're stupid. And I feel like, again, and there are no crimes there to prosecute, but if regulators occasionally put these companies through pretty painful investigations, maybe that would dial some of it back. But in terms of fraud, there is a lot of fraud out there now. There is. And then you get that category that's hard to prove, where it's the forward-looking kind of fraud, where, well, we're not lying about our past financials. We hardly did any revenue, but, we're going to grow revenue, 20x in the next 5 years. It's hard to prosecute that, but I think because you really have to show that they knew that those were not good faith, or that they knew that those statements were not realistic. But I think if you got some investigations and some attempts at prosecution, even if they result in losses for enforcement, it would still have a chilling effect on manipulation and egregious conduct. And we just don't see that these days. Final point on that, just a guy named Jesse Eisinger wrote a book in 2019, I think, called The Chicken Shit Club. and it's about how the United States Department of Justice, everybody just got so scared of losing cases post Enron that they don't go after hard cases.
Right. I want to touch upon this environment that you're talking about. Post the great financial crisis, central bankers have donned a certain new role. And I would say that probably we are in a new era of financial markets where there's a lot of money that has been printed by central bankers, and now even central governments are donning the role of, pumping up the economy. Maybe they are required to do that. They don't have a choice. But it seems that you've got into this loop of pump, inflate, crash, repeat, right? And so we are into some kind of a distorted, and I think, you've made the point before that the financial markets are broken, right? And that we've seem to be getting into this financial system, which is always in this repeat mode of inflating asset prices and only to fall them and making the system even more and more fragile. Because I noticed that at least in the United States, corporate debt is rising with every passing such phase, right? So you're actually making the system more and more fragile, as you move forward. So is this a phenomenon that you see repeating, and has that made the system more fragile?
Yeah. Okay. So first of all, I'm not a macro person, but
Sure.
I've referred to this. I fully subscribe to that description. We have a financial crisis or an asset crisis that bleeds over into the real economy, and funding seizes up. So how do they try to cure that? More credit creation, and it just becomes a bigger problem, and it repeats. We're in this endless cycle. I call it the powder keg economy. We just have to build a bigger powder keg each time it explodes. I mean, when in March of last year, we had a good month, and we didn't have any activist campaigns because, we just sort of we expected this, I mean, what we were sitting there thinking what do you think you get when you build all of these really fragile balance sheets? You've been doing this for years, and going back to the early days of the recovery from the financial crisis, the mantra of the Fed was, we need to encourage risk taking. Well, I mean, I'm in 2012, I'm looking at really stupid risks being taken. 2011 even. I mean, if you remember Ike Batista's X Group, I mean, there were always, even in the early days of the recovery, these just grotesque distortions of capital allocation created by, forcing people to chase higher yield and greater risk. And anyway, so yeah, you think it could, at some point when, when it blows up for the nth time, there isn't a policy response that can handle it, or that's capable of, pulling things back out of the toilet. But I don't really know. I have been amazed, and I was caught flat-footed last year because, all these genius trades we put on in March that were great, we kept them on into, July and August, and, where we'd given back most of the gains. So I really don't know how and when it all ends, but I also feel that this is there's much greater fragility, obviously, from all the debt in the system, but it's also misallocated capital. And one of the points that I make, and I've been making this honestly since 99 and 2000, when during the tech bubble. So maybe it's not a good point or a valid point, but to me, one of the problems is that when we have these financial bubbles, it leads to a misallocation of human capital, because it's signaling that you should go and get degrees and training in this field and go, flock to that field. And then, this field doesn't really exist but for cheap money. So if that does come to an end, I feel I saw this on the back end of the tech bubble. A lot of people who'd gone into tech and just weren't employable in tech, and they lost several years of their lives, and their incomes reset down here. It probably took them a long time to get back. So yeah, when we look at sort of the cycle that the West is caught in, where roughly every 10 years we have one of these blowups, and the people who had just finally gotten back to even from the last crisis just get flushed down the toilet again. I mean, yeah, how long can this hold? I mean, is it really a shock that, we have popular politicians like AOC and Bernie Sanders and Elizabeth Warren? I mean, the masses are pissed. So
Right.
I don't know how much longer this can continue.
Right. From our perspective, for the benefit of the listeners, basically, India is integrated with the world. I mean, in February and March, it wasn't only the US which went down in the stock market. India collapsed along with the world, and India has risen along with the world. So we are far more integrated as far as the markets are concerned and as far as the economy is concerned. And clearly the US is the mother market, and what US does and initiates has an impact on our market. So it's important to understand these trends. And from our perspective, I think, as you move forward, you're going to have a lot more volatility. The volatility will continue, and it's going to be a little more macro-driven, market as you move forward. At least that's the way we see it. But Carson, as an observer as to what's going on in the US, it's the good times, the best of good times and the best of bad times. You see some of the best businesses getting created in the US, like Google or Apple or Microsoft, who's building a new search engine, right? So it's such great network businesses with such high profitability getting created. But then you see, and I'm not making a judgment on this, the SPAC boom, right? Where $100 billion get raised in 4 months. You see Bitcoin at $1 trillion, Coinbase at $100 billion. Tesla at, I don't know, $800 billion market cap. And some people say it's just a car company. So you kind of see this good things and bad things happening in the US, and you wonder how much of that is the effect of what the central bankers have driven, and how much of that is induced, and these are unintended consequences of that. So one, do you agree? And second, do you have an opinion on Tesla? Because short sellers have got creamed shorting Tesla.
Yeah, so look, number one, I agree. I think that the loose monetary policy lends itself towards an oligopolistic economy, especially because debt is cheap and funding costs for the big companies are incredibly low, and they can just buy all the small companies, and they're able to. I mean, the publicly traded companies are just massively able to outcompete non-publicly traded companies for capital. And so it's and there's also, when you look at these companies, I put Microsoft in a different class than the others, because Microsoft is really interesting. It was a tech monopolist. It was really reined in by the government, had some very tough years. And then, I wouldn't say it reinvented itself, but it figured out how to thrive in the new environment, and it's once again one of the most impressive companies in the world and most valuable. In terms of Tesla, yeah, I mean, look, nothing there makes sense. I mean, economically, the business doesn't make sense. The accounting's horrible. The governance is among the worst governance of a non-fraud that you'll find. I mean, they literally cannot even get directors and officers insurance for their their independent directors. Not that there's any such thing as an independent director, especially if Elon Musk is the controlling shareholder. But it's hard to short. I mean, we a few years ago, this is how we had a short on it. And it almost paid off, actually, but we went long the bonds. And so we used the cash flows from those bonds to buy long dated, deep out of the money puts. And it was a slightly carry positive trade. So I have never been just directionally short the underlying of Tesla. It's just been very difficult. Now, a fund manager who I respect and is, a smart guy, he also has this theory that Tesla is really kind of the linchpin for a lot of the froth in the US markets, especially because as it's gone up, it's created all this account equity that is led to, margin buying on the back of Tesla valuation. So kind of interesting. I mean, when that stock does break, what the, knock-on effects will be. I mean, yeah, look, it's, it hasn't had great, years so far. And since mid-February, I mean, the really speculative garbage in the US has come down. So maybe that's also kind of proving it out a little bit.
I read somewhere that there are 400 Chinese companies of Chinese domiciled companies which are listed in the US. How would you characterize those 400? You found a lot of frauds in the Chinese accounting. How many of those 400 companies do you think are sanitized, clean, and how many are really frauds or,
I mean, how many are really clean? It's a lot closer to 0 than it is to 400. I'll tell you that.
Of all the 400.
Well, so, okay. Here's China. And I think people have to live there to really believe this and understand it. But in China, there's so much lying and fraud that a real company is one that literally invents 20 to 30% of its revenue. Okay. Like that's real. Like that's just, that's a great company. A fraud in their view is one that's 70% or more fake revenue. That kind of 30 to 70 zone is a gray zone. I don't really know, kind of how they feel about that. But that's just the environment there. Like when you're talking about other people's money, it's just guaranteed to be, almost guaranteed to be fraud there. So that's one factor. Okay. There's the mentality, of among just the society there, and especially the investing class. So then if you have a company, you're a startup company, your competitors are committing fraud. They're your competitors for capital, for VC funding, for IPOs. They're committing fraud. What are you going to do? Like you're not going to let your company get funding and get to the next level. I mean, you're going to do what you got to do, especially because the kicker is this: there is zero recourse that the United States has to you if you do this and you get caught. There's no recourse. The United States government has never held one PRC national who is a chairman or controlling shareholder of one of these companies materially liable. I mean, great example.
How many frauds, Chinese frauds, have you identified and disclosed? Yeah.
We have 7 that were delisted. That does not include Luckin, because Luckin wasn't our research. But if you want to add that'd be 8. And Luckin is a great example, because Luckin was about the most accountability that's ever been imposed. Luckin raised from U.S. investors, I think, $800 million.
Wow.
And it turned out to be a large fraud.
Wow.
The settlement with the SEC was for $150 million.
So for the benefit of the viewers or the listeners, Luckin's was the equivalent of Starbucks of China. And it was a $10 to $15 billion market cap company.
That was the story, but but there wasn't a ton of reality to it. But they basically paid a 20% commission to the SEC for the money that they stole, and that's by far the most accountability the SEC has ever imposed against a controlling shareholder who's from the PRC. Now, in the first wave of fraud implosions, there was one chairman who did actually get sent to the US and did prison time, but he was from Taiwan. So that's why. So basically the PRC, and so then the PRC government officially created a big moat around these frauds and made it so that the PRC now expressly prohibits any entity or individual within China, so that includes auditors, that includes company personnel, from cooperating with an overseas regulator's investigation without the express prior consent of the China Securities Regulatory Commission.
Why does that happen? Why doesn't the regulator want to clean up the system? Why doesn't China want its companies to be,
Because there ain't no system but fraud. Like everything there is somewhat fraudulent. These companies cannot, they do not, I mean, look, maybe there's some where the numbers are really, truly, honest, but my belief is that the vast majority are, I mean, we can, my team and I, and we're very familiar with China and the taxation and the accounting there. We can look at any of these and find the red flags, especially in the taxes. Screwing up tax rates is just especially in a complicated regime like China, where there are various tax incentives in certain locations and certain industries, and there are all these different entities. Screwing up the tax treatment is like it's almost a guaranteed byproduct of the fraud. It's just very difficult.
So what does it tell you about the Chinese system or the Chinese economy? I mean, it is competing for leadership with the United States. What is it? And I know that you've written a book called Doing Business in China. But what do you think is the future of the Chinese economy, if that's the culture?
Look, for a long time, I've been saying that it's a credit and asset bubble far larger than that in U.S. subprime and real estate, leading up to 2008. But I don't know, despite my feelings, it hasn't really mattered. They're able to keep it going. They're able to keep it together. But one of the things that I've also theorized, and maybe it's another one of these kind of bizarre, theories, like my misallocation of human capital view, is that you can look at how much waste there is in China's GDP by essentially assuming that household consumption is a healthy number. So everybody looks at China's GDP and they look at the percentage of it that's household consumption, and they say, well, gee, if China were to, be, if they could get their consumption up to be more like that of their Asian peers, then, really this would be much better balanced economy, and GDP growth would be even greater. But I kind of look at it, and I haven't run the numbers for a few years, but I used to kind of show this slide sometimes when I spoke about China. If you looked at the CAGR of household consumption from 2000, I mean, it compounded at like 7 or 8% per annum. So, I think, well, because there's so much waste in the fixed asset investment in China. I mean, you go there and you look around and you see just everywhere you look, things don't make sense, major empty buildings and just so much waste. And so think like, well, maybe what this is telling us is that this is actually, the household consumption is actually the baseline from which we should judge what the non-value destructive portion of China's economic output is. And I mean, look, every economy there's waste, but I started talking about this concept of excess waste. And so rewinding a few years ago, if you assume that China's household consumption is more or less is in fact in line with its Asian peers, you get like 25% of China's GDP being excess waste, being value destruction. I mean, and to me, intuitively, based on all my, my experiences there, about 6 years I've cumulatively lived there, that feels about right. That 25, maybe even 30% of the economy is just bullshit. So.
Wow. So is there when you look, you of course detect frauds across the world. Is there a cultural angle to where the frauds are highest, or is this non-cultural? Is there a cyclicality to it as well? Towards the end of a credit cycle, you find more frauds, or again, is that across time horizons? Two questions.
Well, I think, so I think if we're talking emerging and frontier markets, fraud is always there. I think one of the things that Western investors just aren't prepared for is that when you're in various jurisdictions like China, like India, that have a weaker rule of law, fraud is just much more prevalent. And I think we have so much naivete when we come from the US and we go to emerging and foreign markets. So EMFM fraud is always, I mean, for the foreseeable future, is always going to be a real factor because of the weaker rule of law. And I get that it's could be getting better over time. I mean, I can't opine intelligently on India, but in terms of US, yeah, I mean, there's generally US and Western Europe, there's generally a cyclical element to it. I mean, when you get towards the end of a credit cycle, I think there is more fraud there. But yeah, I mean, we're not really at the end of the cycle, I guess. So,
Right. I think it's time we should take some questions. Let's check. So there's a gentleman who's clearly an admirer of what you've done, and he likes the report on NMC Health and VR Shetty. He has a question. It's not that difficult to filter decent companies, good companies. It's not that difficult to filter bad companies, but how do you and your team filter and come out with a list of companies that can be? So what's your search strategy? I think that's really the question that this gentleman is asking.
Yeah, so there are other activist short sellers that I think run screens. I mean, we don't run screens. The way that we find potential shorts, it's so one avenue, if we're doing this strictly internally, is we follow certain people around. So lawyers or other service providers sometimes lead us, or stock promoters lead us to something. We also look at what seems too good to be true, and where risk could be really mispriced. But on the short side, a big part of it is also just the network and talking to people. And so, we'll talk to long investors who will say, hey, I had a meeting with this one company. Something seemed off. I mean, we're not, we're moving on, but you might want to take a look at it. And a lot of what we do is very qualitative. So we're looking, we love looking at transcripts and just reading, say, 4 straight years of transcripts and seeing how promotional management is, and, big announcements that then just disappear, or questions they consistently evade. And it's hard to tell that in real time when you're on the call. We see this all the time in transcripts. When somebody asks a question and the CEO will just have this long response with lots of buzzwords, and, and the person who asked the question is like, oh, he probably answered it. I don't really know what he said, but okay, thank you. But when you look at the transcripts, you say, wow, they did not answer that question. So you feel like there could be a soft spot there. And you have to think about how significant that is. So a lot of it is qualitative for us in that regard, but we also get pitched ideas all the time. You go back to my comments earlier about there not being a financial investigative media. So guys who have done the work and are short these names will come to us, hoping that we'll kind of take up the cause. The vast majority of those we don't move forward with. We always go deeper than the people did who gave it to us, because that's our business model. But yeah, I'd say it's very much qualitative and looking for what seems too good to be true. And in the case of Shetty, there was just some obvious stuff there. If we're talking behavioral, okay, like the guy always and maybe this sounds petty, but to me, there were behavioral tells there, like him always wearing around that medal that he got from Abu Dhabi. And, then we saw this Bloomberg interview with him, and when he was getting ready, talking about Neo Pharma maybe going public, and he's saying, oh no, this isn't to make me, rich. I want to share this with others. When we see people making statements like that, like, we know they're lying, like, come on. But the truth is about NMC, like, we knew that they had hidden debt. We had no idea that it was almost, it was 2.5x what was reported. That was a shock. Like, we were surprised by the magnitude of that fraud, but also the related party transactions that were undisclosed. And, you could just look at, we made a point of it in our report, looking at the Bright Point Hospital. The construction costs were so high relative to what they should have been. You see that, one time, I guarantee you they're doing it all the time.
I have another question. Given recently what happened with Archegos, and you were the first person to call out on GSX, what's your take on the entire situation?
Well, I'm still trying to figure it out. It was interesting because the guys who have not gotten nearly as much attention, this fund in New York that focuses on China called Teng Yue. And so Teng Yue, the principal there, is a guy named Tao Li. And so he had been at Tiger Asia under Bill Huang. And, so Tiger Asia, folded, and Tao Li started this. So when I first learned about this, I heard that Tao Li, Teng Yue, and Bill Huang were really the two who were pushing this thing and squeezing it. I had assumed that it must be more Teng Yue than Bill Huang, because I was thinking, yeah, I don't know, like what, former Tiger Asia principal. I mean, maybe if we're being really aggressive is worth a B, but yeah, who knew that this dude was slinging around 100, 150 B in total balance sheet? So yeah, I think it's manipulation. All right, supposedly Teng Yue spent money on a due diligence report that shows it's a great company and whatever. I don't believe that for a minute. You're smart money China, like they are. Bill Huang is. You spend $50,000 on researching GSX. That would be a lot to spend. You will learn this thing's a near total fraud. And so supposedly the price tag on this report, what I heard was $2 million purportedly of due diligence. I confronted one of Teng Yue's LPs about that last August or September, saying like, that's complete bullshit. There's no way you could spend that much money diligencing a company that has 0 real world stores. And he said, well, maybe it was across the online education space, which again, same thing, like would be, to me, is just it's like obvious, it's an obvious red flag. So I think, my opinion is that was the fig leaf that they used to coordinate the squeeze, right? Because if I'm long something and I think it's a great company, I certainly may share my research with you, right? And, and if you agree, you'll buy it. But I feel like these guys kind of having worked together in the past and, coming out of the Tiger complex, it was basically a signal for, yeah, we can choke the float here. We've got this guy in Singapore who's got a fund called QQQ, who was bragging about how he was selling at the money put options, which was through delta hedging, pushing the stock up. Through those dynamics, they were able to squeeze the stock. So if that was coordinated to the extent I think it really was, I mean, to me, that seems like that would be manipulation. And I think the saving grace here is, this never would have been investigated for manipulation. Absent arch egos blowing up. I suspect they will investigate it now. I hope they do. And yeah, I don't know, but I don't think that was kosher in the least.
It's not easy being a short seller, right? Apart from other hedge funds, now it's the retail investors who want to squeeze the shorts, right? But how do companies respond when you put out a report that they are a fraud? How do companies respond typically?
Well, okay, so again, most of what we do, we're not saying that you're committing fraud. It's, you're misrepresenting the financials. It's legal. The companies that are really filthy and the ones that we basically do accuse of fraud, they seem to be the ones that get really sensitive, and it's funny because they constantly seem to pay these crisis communication firms that give them the worst advice. And they come back at us with ad hominem attacks, well, this is a short seller who's just trying to make money and drive it into the ground. And, and they often will put out what seems like a detailed response, and they'll take the questions they wish they were asked, not the questions they actually were asked in our reports, but that they wish they were asked, and say, accusation, blah, blah, blah. Again, not really the point, or, often twisting what we said. Wrong. Here's the truth. And then they spit out a bunch of verbiage that looks kind of convincing at a glance. And, I think the theory there is, on the part of the company, is that, most people are too lazy to really read our report. And then they're going to be too lazy to read our report and the response and really try to compare them and think about them. So we then have to come back and say, no, these are the key issues. They did not answer those. And when they did say this part was a lie. So yeah, a lot of the times the really bad companies respond.
The pattern repeats, right? It's the same thing every time.
It generally repeats. The smart thing for a company to do is to honestly say something like, okay, noted, we disagree, but, we're just going to put our heads down and try to focus on the business, and we'll increase and improve our transparency. But a lot of times the companies that say we're going to improve our transparency, it's really manipulated form of transparency. It's faux transparency. But I think the companies that responded in a healthy way, and maybe I'm saying this because the stocks have just slid, but company, U.S. company called Inogen that we shorted in early 19, a company we shorted April of last year called eHealth. eHealth, basically owned up to it. We didn't say they were doing anything illegal. We just said that they were juicing their revenue growth numbers by pursuing really low quality growth that was just destroying cash. And they took a step back and they basically said, yeah, they're right. We shouldn't be running these TV advertising campaigns to get these really low quality subscribers. And they've dialed that back and they're focusing on quality. Now the valuation has collapsed because they were trading at 9 times sales for what appeared to be a fast growing business that was, fast growing on the back of a change in accounting standards that really allowed them to be aggressive with, the revenue they were recognizing. So I think they've been less aggressive with the revenue recognition as well. So that's healthy. Look, like the stock's gone down, but the company I think is going to make it as a result of them being realistic and saying, yeah, let's stop incinerating cash in the name of low quality fake growth.
I have a question from someone. Is Amway a fraud?
Sorry, which one?
Amway. Amway. Yeah.
It's always been all the MLMs are controversial, right? There's
Bill Ackman shorted one and unsuccessfully, right?
Herbalife. Well, he was right, but he didn't make money. So ultimately, the Federal Trade Commission agreed to what for them was an enormous settlement. They got paid $100-something million by Herbalife, but Herbalife just kind of was like, brought in the lawyers, ticked the boxes, create some more paperwork, and whatever. So though, in general, and I don't have any specific knowledge of Amway, but in general, the charge is that those businesses basically defraud the people who buy the products. They defraud them by making them think that this is a way to get rich, but these are effectively just pyramid schemes. Yeah, I think there's merit to that, but I don't think it matters. Just look at Herbalife; it didn't matter.
There are a lot of questions around risk management. That as a short seller, the downside is really unlimited theoretically. So how do you really manage risk? When do you cut your positions? Yeah.
So for us again, it's hard to compare us to traditional non-activist short sellers because the dynamics of an activist campaign just are much different. The stock responds much differently from something you're just short and hoping is about to blow up. But the guys who've stayed in business in traditional short selling, and there really are not many of them, they've done it, I believe, like Chanos, by sizing positions generally at 1% to 2%. And that sucks because when you think about what that means in terms of the number of names in your book, the bottom of your funnel is 70 to 80 names. The top of your funnel must be hundreds of names. And the resources required to research these companies, feel like you understand them better than the longs and you have an edge, and get down to 70, 80 names are substantial. So, you can't do this on a small AUM base. I think you got to be at least $1 billion to make it work. And right now it looks like Kynikos and Sophos are both well under $1 billion. And those guys are the biggest in that kind of traditional short it and leave it space. So it's very tough. For us, last year was a tough year. We learned to be much better traders. If it goes up a lot, we trim. When it starts going back down, we add. It's not, like you could look at it and say, well, gee, if you liked it at 10, wouldn't you love it at 15? And you should make it bigger. But nah, man, to my view is the way that markets work right now, and just how easily things are pushed up for, what are really non-fundamental reasons. You just have to take the opposite view. And when you think it's finally breaking, that's when you add, but you got to be prepared to get right back out. And like a lot of people ask about Melvin, and look, very smart, and very smart investors. Gabe Plotkin's a very smart guy, but the sizing on their shorts was they were just way too big in their shorts. And so that's the other thing. I mean, you cannot be that big. You shouldn't be multiple days of average volume in a short. And so it's like the opposite problem occurs, right? Whereas you need scale to do the work, and have a real short book. But if you have too much scale, you can't put the money to work, and you end up, dangerously sizing your positions relative to the volume, not relative to the capital. So you really have to think about your position sizing relative to capital and relative to volume. And nobody's got it. Nobody's right sized in the market at this point, from what I can tell.
I've always felt that a short seller needs to be far more diligent in his research, far more than a long only guy. And the other skill that's required is really risk management. And those are the true skills which really make a good short seller. I have a question on, do you have a view on Bitcoin?
No, sorry. Well, so actually, let me repeat one thing on that though. I've got a friend who's he was a founder of a very well known in the U.S. Company that hasn't yet gone public, and he's now on his next venture, and it's blockchain venture. And he owns a little bit of Bitcoin. I mean, he's an insanely wealthy person, but I was. So since he's in the blockchain world now, and there's kind of like a crypto element to it, to what he's doing, I was just over text the other week, he was saying, well, the value of a cryptocurrency is the gas usage, or I think he said the gas fees. The present value of the gas fees. I'm like, what's that? It's basically the usage fees of the blockchain. So then I said, okay, so if we look at the valuation of Bitcoin, then it's basically all tulip. And this guy's long some Bitcoin, not in an amount that's meaningful for him, I think, but he came back and he said, well, yeah, it's basically almost all tulip. So for what it's worth.
I can go on and on. There are so many questions, but I just want to ask you, what's next for Carson Block? What's next for Muddy Waters?
Well, I mean, just trying to, get out of COVID, I guess. But yeah, I mean, we're looking at expanding we've been talking since 2019. The idea was since early 2019 that we would look to ultimately become a form of multi-strat, where really a collection of probably niche subscale strategies that are really focused on, heavy research, maybe can benefit from public communication and the brand. Look, we were going to move to New York this past summer. We're not moving to New York now. So maybe we go multi-strat. But we've also, one of the things that we've been working on for about a year is a long-oriented product that's really going to look to capitalize on what we think is going to be the redirection of a lot of FDI dollars away from China. And I mean, that was happening before COVID. I suspect, it's possible that when we're really on the back end of COVID, that people of the world are going to look around at, smashed economies and, businesses that have closed, people who they know who've, been hurt, killed, whatever. And there might be some real grassroots fury at China. And, when you look at the US and the West's relationship, trading relationship with China, they were always business was always able to kind of co-opt government officials and lobby away any real barriers. And that might just be, Trump changed that to some extent. He didn't always really believe in the trade war, but the EU is where it gets interesting. And I think that they've become and are continuing to become more jaundiced toward China. And so, we're looking for the beneficiaries of the redirection of FDI flows. And, India is going to be one of those beneficiaries. That's not, that's not somewhere we're going to really spend time because, like honestly, I have no edge versus you in India, and there's no point. But I think there are a lot of other places, particularly in ASEAN countries, and even Mexico, even reshoring opportunities in the United States, Europe, where there could be some interesting things. So that's something that we're looking at, is actually a long-oriented product that just kind of capitalizes on my long-held view that the world really needs to realign its relationship with China.
Interesting. I can talk to you for another 2 hours, Carson, but we'll thank you on this at this moment. And, we'll just hope that you can come back at a later time and we can dwell on more issues and converse with you again. Thank you so much for your time.
Thank you. And to, you and everybody else, stay well and good luck. So,
thank you.
All right.
Thanks. All right.
Thanks.
Bye.